Yes, and everyone with a mortgage or thinking about getting a mortgage is going to be watching the Reserve Bank Board meeting at 2:30 tomorrow afternoon. Speculation rife that there will be an interest rate cut. With the official cash rate sitting at 1.5%, the RBA is expected to lower the rate by 0.25% to 1.25%, which will save you roughly $50 a month on a $300,000 loan, if it's passed on in full by the banks, something that Lou on the text line thinks may not happen. Martin North is a local financial analyst based at Thirroul, and he joins me on Drive Now. Hello there, Martin.
Hello.
Is it going to happen tomorrow, the rate cut?
Well, it's not totally 100%, but, it's what they said is they probably will, I think. But they did say also they're looking through to the wage and employment situation, right? And those are looking a little stronger. So I would say it's sort of 95% probability, but not necessarily completely done deal.
When you say they're looking at the wage and employment situations, how do they affect the interest rate cut?
Well, the point there is that the Reserve Bank basically has an inflation target of 2 to 3%, right? And we're below that at the moment. Right. But they've said over the last little while that they won't just look at the inflation targeting. They'll take account of where the wage growth is and where employment is. And employment actually is pretty good. Unemployment's quite low at the moment. So if they look through the low inflation towards the expectation that wages are going to rise, and of course we had the recent announcement of the awards going up ahead. And
that's right, the minimum wage,
Yeah, exactly. So it is feasible that they might say, well, that might do a little bit of heavy lifting for a month or two, and we'll see how it goes. Or they might say, well, we've already said we're going to do it, and we'll do it.
Do they often look to these other factors, or is this only when inflation is stagnant that they'll then look to wage growth and employment?
Well, it's really interesting because historically it's been pretty much 2 to 3%. If it's below, we'll we'll cut rates and vice versa. But because all around the world, this isn't just an Australian thing, inflation is stubbornly low. Now central bankers are scratching their heads thinking, maybe we should be looking at other things. Maybe we need to try alternative strategies. So this whole linkage of cash rates and controlling the economy directly off the cash rate looks to be bust at the minute.
And so I guess this doesn't then specifically say something about Australia's overall economy, or does it?
Well, I think it actually does, because you have to look more broadly at some of the other indicators. Our GDP number's pretty low, and that's a worry. And a few other things have gone there as well. So, it looks as though we have got inflation probably staying very low, but wages growth probably still being low, and employment probably looking a bit wobbly. So unemployment will rise. Now, if that is the case, then I think probably our economy is a lot weaker than it was presented to us before the election.
Interesting. So do you think that the suggestion there could be as many as 4 interest rate cuts in the next 12 months could be on the cards?
Well, it's pretty remarkable because, we haven't yet got all the evidence to suggest that our economy is really, really weak. And to be frank, that we normally would expect rate cuts after a crisis. That's what happened in the global financial crisis up in the Northern Hemisphere and down here as well. So this weird talk of all these rate cuts now, when we really haven't headed into a crisis, is really quite strange. I don't understand, honestly, why the wind has changed so dramatically in a couple of weeks, because everyone was saying it's pretty strong, employment's okay, etc. But suddenly now people are saying, we need all these rate cuts. But even if we cut the rates, the question is, will it really have any impact? And that's partly a question of, will it transmit to lower rates for real households? And secondly, more broadly, even if rates are cut and households have a little bit more money in their pockets, are they going to spend it? Because many households are struggling with the bills at the moment, and frankly, any relief may simply go to paying off the loans and other things that they've got. So it may not translate to improvement in the broader economy.
So is the RBA lowering the interest rate, it's a method by, apart from being a reflection of various factors, it also is a way to try and kickstart the economy. But if people are just going to use that rate cut to pay off their credit cards or anything else, then it won't have the desired effect.
Well, that's the point, you see. About half of the economy is driven by household consumption. In other words, we spend at the shops, we buy things, and that flows back into the economy.
And that's predicated on, say, the minimum wage growth, or the rising of the minimum wage was predicated on that as well, that people will have more money in their pockets from minimum wage and will spend more.
Yeah, exactly. But, it's all relative. It's a relatively small increase from the minimum wage, and people are really struggling at the moment with, just keeping, everything that they have to pay. There's a lot of demand on their finances, childcare, healthcare costs, fuel costs, all of those things. So a lot of people are saying it's quite tough at the moment. And so the question is, would it really have enough of an impact? The economy is being supported predominantly by the fact that we've got very high iron ore prices. The government is spending big on infrastructure, both at the federal and state level, but business investment and personal consumption are both well down. So it could well be that we see the results later in the week that the overall GDP number will be very low, which suggests that the economy is much weaker than people were saying. Then it becomes a question as, well, if we do cut the rate, will it really make much difference to what people are going to do?
Can we just put the price up of iron ore?
Well, we're 110 or thereabouts at the moment. It's remarkably high, predominantly thanks to issues in Brazil, and China's still buying it, right? So we are very exposed to these international dynamics, and particularly, I think, China. But the local economy is looking a bit wobbly at the moment.
During the election, we were promised federal budget surpluses. I think that was said quite a lot, based on a strong and recovering economy. Do you think that is a correct prediction? Well,
they certainly want to keep a surplus, but of course there is this little get-out clause that says, well, we're going to give a 1% dividend cut to the public sector. In other words, they've got to find more ways to skinny themselves down further. So I think we're going to see significant pressure on government budgets to try and keep things together, unless they declare effectively an emergency, and suddenly say, well, because the trade wars have really blown up, or China's off the boil, or Brexit's caused an issue, then that might say, well, we've now got to actually go into deficit again. But I think they will do anything they can to try and keep in surplus. Of course, the question is that right at this time in the economic cycle? You could argue that government should be spending more if the economy is really weak at the moment. And so there's a really interesting tussle between, if you like, doctrine, which says maintain surplus, and broader economics, which says sometimes it's good for governments to go into deficits to support the economy.
Yeah, and to provide community services and things like that.
Exactly, because, of course, it's the community that gets hit when services are withdrawn.
I guess we do have possibly another financial year to go until those tax cuts that were promised before the election come into play as well. So there will be a little bit more money in the coffers as a result of that.
Well, at some point when we know precisely when they're going to come in, because there's a question of when those reforms get passed in Parliament and things. So it's all a bit wobbly. But the bottom line is this: household costs of living are rising very fast at the moment. Many times, I think, higher than the CPI reported figure. And we know that incomes are flat. So households are really feeling the draft at the moment. And so I guess if there's any relief at all from interest rates, that's a good thing. But I just worry that in the scheme of things, it's going to be pretty marginal.
All right, well, thank you for breaking it down with us again, as usual, Martin North, and have a great evening.
Good to talk to you.
Cheers. Martin North there, local financial analyst, giving us his thoughts on the 0.25% lowering of the cash rate, which will more than likely happen tomorrow and could be the first of a couple this year. You're listening to ABC Illawarra.